bracket dealers still handle the majority of client flow at about 60%. But we've seen since the financial crisis a trend that continues, where middle market and regional dealers continue to pick up flow from clients who are looking for particular expertise, whether that be in special particular sectors or different regions or markets around the world where they can provide that high-touch service in those areas where the bulge bracket banks don't have the sort of time or willingness to work with those clients to do that. Their use of electronic trading, while I think traditionally lagging the bulge bracket that had more resources and technology deploy, that's starting to change as the third-party providers that offer the technology to those middle market dealers help them to really come up to that level. And increasingly they need to offer that technology solution to be relevant to their clients, and we're only going to see more of that going forward. We shouldn't expect fixed income markets, especially the less liquid ones, to start to look like equity or futures markets. It's not the market structure. It's been proven time and time again that not only does it not work as effectively as it could, but clients often aren't looking for that. We are seeing quite a bit more automation in those markets. Even in an RFQ space, clients on the buy side that will generate a request for a quote automatically for smaller size orders, dealers then responding to those quotes automatically through pricing engines, and the whole transaction can actually go through without any human actually touching or looking at that trade, despite using the RFQ protocol, which is seen as more of a high-touch protocol. So we'll only see more of that. For emerging dealers, often that can be a great way to attract new clients, is to be able to respond with aggressive pricing and respond quickly to those orders. And if they do that consistently, then even bigger asset managers could start to spend sort of more time and send more flow their way. There's a lot of ifs, ands, or buts with that, but we do definitely still have quite some ways to go. Corporate bond trades in the US, only about 20% of volume is done electronically. I don't think we should expect that to get to the 50% or higher mark, but we certainly could see a third of volume traded electronically over time, which is still a pretty big runway there. US Treasuries, about half of volume traded electronically. If we look at European government bonds, it's higher than that, so I think room for growth there. MiFID II, which is only just really getting underway. While it doesn't require electronic trading in many of these segments, a lot of the other rules about pre- and post-trade transparency will certainly encourage market participants to trade more electronically, so that should only see those numbers grow. And then as the market gets more comfortable with protocols that are relatively new to these markets, or at least being deployed in new ways, whether that be all-to-all or different auction protocols, that will also boost the amount traded electronically. There will always be a debate as to what is true electronic trading, but I think ultimately it doesn't really matter as long as there is some automation that makes the flow more efficient, less error prone, and allows investors to have their needs met more quickly and at a better price. We should encourage that regardless of the details.